Banking Lesson 3, Understanding Interest and Inflation. In this lesson, we're going to explain the different types of interest, how inflation affects money, and why it matters to you. So, what is interest? Interest is the cost of borrowing money. Typically, you pay interest when you borrow money. You can also collect interest if you lend someone money. For most people, the easiest way to collect interest is to open a savings account.
When you have money in a savings account, the bank is technically borrowing it from you and paying interest in return. This doesn't mean that you don't have access to your money. Banks just make money by lending money. Now, don't be fooled. The interest that banks pay on savings accounts is a joke. The interest rates that they pay are way below inflation, but more on that coming up. For now, let's dive into some different types of interest. Simple interest is interest earned only on the principal amount. The principal amount is the amount of money that you have in your savings account that's just sitting there. And to be honest, most simple interest rates aren't the greatest. So don't put your money in a savings account and think that it's going to make you a ton of money on the interest. Some people make a big deal about getting the best interest rates, but the reality is they won't really affect you when you're just starting out. Interest on savings accounts can range anywhere from 0.01% into the 2% range on the high end. Many of the well-known big banks offer some of the lowest rates. Some of the highest earning accounts may require minimum balances in the thousands of dollars. It helps to double check that figure before signing up. So don't fall in love with a high rate only to discover that it requires $25,000 to get it. As an example, if you have $500 in your savings account with a 1.4% interest rate, you're going to earn a whopping $7 a year.
Here's another example with bigger numbers. If you were to put $5,000 into an account that earned the national average interest rate of 0.28%, in a year, you'd be about $14 richer, assuming you don't add any more money to the account.
Put that same $5,000 into a savings account with an interest rate of 2.5%, and your yearly earnings are going to jump to $126 a year. That's assuming you had $5,000 put away in the first place. And even then, a 2.5% interest rate is way below the inflation rate right now.
Remember, a savings account is just a place to park your money while you're saving up for a specific purpose. It's not going to make you a bunch of money. Next up is compound interest, and it's one of the most important concepts to understand when wrapping your brain around how money works. The most common type of compound interest accounts are geared towards retirement and investing. That's not something we're going to cover right now, but it is important to understand the differences between simple and compound interest. Compounding is a process of growing.
Think of the snowball effect. As a snowball rolls downhill, it builds upon itself. Compound interest does the same thing. It's money earned on the money you previously earned as simple interest. Compound interest essentially means interest on the interest. Let's break this down by comparing a simple interest account to a compound interest account. Let's say you do a one-time deposit of $500 and your interest rate is 1%. After a year, your simple interest account will have earned $5. Your compound interest account will have earned the same. However, if we jump forward 10 years, your simple interest account will have earned $50, while your compound interest account will have earned $52. Because compound interest is interest earned on the current balance as opposed to the original balance.
If you jump forward 20 years, your simple interest account will have earned $100 and the compound interest account will have earned $110. By the time your $500 has been sitting in an account for 40 years, you will have earned $200 in a simple interest account compared to $244 in a compound interest account. This might not seem like much of a difference, but we need to take into consideration that most compound interest accounts actually earn a much higher rate compared to a simple interest account. If you deposit that same $500 into a compound interest account with an average annual interest rate of 10%, you will have earned $50 after year 1 and $22,130 by year 40. That's a huge amount of earning potential by deciding to put your money into an investment account compared to a regular savings account.
So we've mentioned it a few times, but what is inflation? Inflation is a long-term rise in average prices for all goods and services. What this means is that the purchasing power of your dollar goes down and the price of goods and services continues to get more and more expensive every year. Purchasing power refers to the amount of goods or services that you can purchase with a specific amount of dollars.
Is inflation good or bad? Inflation isn't bad for everybody. People with tangible assets like property or stocks like inflation because it raises the value of their assets. People saving cash tend to not like inflation because it decreases the value of their money over time. People who don't own valuable assets hate inflation because it makes the cost of living more expensive and your paycheck doesn't go as far as it once did.
The average annual inflation rate since 1914 has been roughly 3%. That doesn't sound too bad until you realize that at that rate, prices double every 20 years. Something that cost $100 in 1914 would cost over $2,400 now. As of 2022, the inflation rate is over 8%. If it were to stay that way long term, prices would double in less than 9 years.
Because inflation erodes the value of cash over time at an average annual rate of 3%, you can see how much things become more expensive when your money has less purchasing power. In 1970, it would cost you $1.55 to see a movie in the theater. In 2022, the average cost is $9.57. In 1970, a Ford F-100 truck was $3,410. In 2022, a base model F-150 is $29,640. In 1970, a black cup of coffee was 44 cents. In 2022, the average cost is $2.70. You might be asking yourself, why is it important to understand inflation? I'm just trying to figure out the basics. We want you to understand that if you put your money in a savings account, it's only for short to medium length goals. Your money doesn't actually earn you money with the 1 to 2% you might get from a savings account.
On a normal year, if you're not earning more than 3%, then your money is technically losing purchasing power every year because you're not outpacing inflation. Right now, there is no way to outpace the high inflation rates in a safe, traditional savings account that's covered by the FDIC at a bank.
So far, you've learned about the purposes of checking and saving accounts, the difference between simple and compound interest, and how inflation affects your ability to afford the things you need.
In the next lesson, we're going to be comparing banks, credit unions, and online banks in 5 different categories to see how they stack up against each other.